G'day, I am Bryce Robertson, co-founder and CEO of Cultiv8 Collective, and I am super excited to be sharing with you an opportunity to have you understand how we operate a little better and understand our unique position in the marketplace and how you could collaborate with us in a mutually beneficial way. So we've been investing full-time in mobile home parks since 2015. In 2015, we started buying mobile home parks at 12 caps. And in 2017, that went down to 9 caps. And then in 2019 and 20, things started to tighten up. And so we looked at this and we said, hey, we could reduce our investor returns like so many other operators are doing because the market is tightening up. Or we could adjust our position in the marketplace so we feel like we can still bring this same structure to investors, yet work in a little bit of a different niche in the mobile home park space so that we have more wiggle room to be able to keep continuing having the same expectations for our investors. So previous to 2019, we specialized in bringing stabilized opportunities to the space where we were buying anything from 70% occupied to 90% occupied, still a value add portion in there for us to be able to remodel vacant homes and fill them with qualified tenants, to come and fill some vacant lots with newer used homes and fill those with qualified tenants, build back some utility expenses, raise rents, etc. But in 2020, we shifted our focus to not only continuing to bring those deals to the table, but also working with 50% occupied properties where there was a lot more vacant homes to remodel and fill with qualified tenants, a lot more vacant lots to bring to the table. Now, I have a 25-year plus background in construction and construction management, and we are heavily vertically integrated. So we have our own in-house property management, asset management companies. We have our own in-house construction company, and we have our own in-house mobile home financing that we leverage for our new and used homes at our mobile home communities, which really gives us a very unique angle and a unique edge amongst other things that I'm about to talk with you right here. Beautiful. So as mentioned previously, we are Cultiv8 Collective. We've been specializing in recession-resistant mobile home parks since 2015. So a quick disclaimer, I am not a financial advisor, CPA, or attorney. This is for informational purposes only. Make sure to do your own due diligence and make your own financial decisions and lean on your own CPA, attorney, and financial advisors. So we have a really unique edge in the marketplace, not only in the mobile home park space. We have a very unique edge in the mobile home park space. We have a unique edge as operators in the syndication space. So here's some of the things that make us very different from other operators. Number one, we are very vertically integrated. We have our own in-house property management company. Nobody is going to manage our properties as well as we do. We have our own in-house asset management company. No one is going to do asset management as well as we do. We have our own in-house construction company, so we can leverage that for our construction projects. I've got a 25-year background in construction and construction management, and we find that using our own in-house construction crews and team in combination with leveraging some third parties in different markets, we have a leading edge over quick execution of our construction projects that we also get to keep down at a lower cost because we're keeping a lot of those costs in-house. We also have our own in-house mobile home financing, which is essentially our debt fund, where we can, for anything between $1,000 to $9,000 at the park level. So the park would spend or have $1,000 to $9,000 in on each home. Leveraging our mobile home financing, we can increase the value of the property by about $50,000 to $75,000 per lot for a cost of about $1,000 to $9,000 at the park level. So that works out really, really well for us. It also, there's opportunities for our investors to invest in our mobile home financing debt fund as well. But I don't want to talk about the debt fund in too much detail. We can put another presentation together for you on that. Today, I just want you guys to understand a little bit better on how we operate, how we have a unique edge, and really the finer tunings of how we structure our things, because I know what we do is a little bit different. We also bring to the table really strong recession resistance. I would actually go as far as saying, I dare you to find me somebody who is in the multifamily, mobile home park, or self-storage space that is as recession resistant as we are. There's a few things that make us stand out on our recession resistance. Number one, for our projections that we send out to our investors, which we have a 100% track record of exceeding, behind that, we have extremely conservative recession-resistant underwriting metrics, where we can handle, if we do a refinance in the next 3 years, we could handle interest rates going up 2%. We could handle cap rates going up 2%. We could handle cap rates going up 3% between now and exit. We can handle our construction projects taking twice as long as what they actually have been taking. We can handle our property taxes massively increasing, our insurance costs increasing. We could handle us having only 5% rent raises, even though right now we're raising rents 10 to 20% year on year. And all of these things combined put us in a position where we feel like we could handle a really strong economic downturn and still meet our projections. And because of this, we have a 100% track record of exceeding our projections on all of our mobile home park projects. And that applies to our milestone timelines plus our financial projections. And although past performance cannot guarantee anything in the future, we feel really strong that we've had a solid track record with that. Something else that makes us very recession resistant is the amount of value add we have in our deals. We have a large value add component to our investments, and we achieve this because we buy anything from 50% occupied to 90% occupied properties with that strong value add portion. We move our construction crews in to live in the communities, knock out all of the remodels, bring in the new homes, and we send our sales team in to lease them up in a really quick cadence. Usually we lease a home up in less than 30 days after it becomes available to rent or sell. And like I said, we have a 100% track record of exceeding our projections. So if you guys are interested in continuing the conversation at any point, make sure to scan the QR code on the screen here, and then our team will reach out and continue the conversation with you. One of the other things I'd like to mention about our strategy here is not many people in the mobile home park space are buying 50% occupied properties, especially at the scale and sophistication that we're doing it. We target a lot of acquisitions that we're targeting these days are 500 lots to 1,000 lot portfolios. So we're talking about purchase prices of anything between 25 to 50 million, and maybe even a little bit more on the acquisition price. Now, operators and companies that come in to buy those size portfolios typically don't want to deal with value add. They want stabilized assets, and they don't want to get their hands too dirty. But we love getting our hands dirty, and we love the construction side of things. We have our own in-house property management, asset management, construction company, and mobile home financing. And our team is really experienced at doing this at a cadence that's much quicker than most other operators. What we see out there in the operational space is most mobile home park owners remodel about one home per community per month, and we remodel about 7 homes per community per month. So on average, we move about 7 times quicker than most other operators. We're all about taking massive action and pre-planning. So we get everything lined up and all of our ducks in a row in the acquisition phase and the due diligence phase. And then our teams are waiting for us to close so they can go in and take massive action, knock out all the remodels, get all the construction done in a really short period of time, and get up to that 100% occupancy in a really, really quick cadence. So that gives us, so our group to be able to go out there and buy 50% occupied properties puts us in a market where we barely have any competition at all, especially on these larger portfolios. Most of our acquisitions are 200 spaces and above. And our real true sweet spot these days, we really love acquiring in the 500 spaces to 1,000 space range as well. Well, a lot of these days we're buying portfolios. We'll have anything from 1 to 6 properties in a portfolio on average. And we have been buying properties as small as 100 spaces if we're going to add it on to existing markets where we already have a strong footprint. Our main geographical area that we invest in is at the Southeast and the Midwest. We're actually, our headquarters is based out of Asheville, North Carolina. We have a very strong presence in South Carolina, Tennessee, and North Carolina. And we're also in the Midwest as well, currently in Kansas and Ohio. And we're definitely expanding in these markets and buying a lot more portfolios and properties in these geographical areas. So why are we interested in mobile home parks? Well, I believe that America's #1 real estate problem is the need for affordable housing. Mobile home parks are the largest contributor to solving the affordable housing problem in America. And when you look at the math of this, it puts mobile home parks in a really unique position where the supply and demand is massively in favor of mobile home park owners. Arguably, wherever you get your information, you could arguably say that about 20% or more of America is in need of affordable housing. Yet, there's only about 40,000 mobile home parks nationwide. So, although we're the largest contributor to solving this problem, which puts us in a position where there's massive supply and demand in our favor, math shows that mobile home parks can't solve this problem alone. So that puts us in a position where we have a really, really strong supply and demand, and we have really strong recession resistance as well, which I'll talk a little bit more about in a minute. And what we've seen is we have a lineup, a wait list of pre-screened, pre-qualified tenants at our communities that are basically waiting for the next vacant home that's available. We've sold homes in as quick as 7 minutes. We have a lot of people lined up, ready to go. And some of our communities, this is when we're not even come into a heavy recession. Some of our communities have over 85 people pre-screened and qualified, waiting on the wait list for the next available homes. So we have a massive supply and demand in our favor. The interesting thing that happens is when recessions kick in, the way that things typically work is people need to downsize because expenses are increasing, people are getting laid off, people have less money to play with. So people go from single-family homes to A-class apartments. They go from A-class apartments to B-class apartments. They go from B-class apartments to C-class apartments. And then we typically see people go from C-class apartments to mobile home communities. And if you're not going to live in a mobile home community, then you're probably sharing a house or sharing an apartment or sharing a room with somebody, or you're living in your car, or you're homeless, because mobile home parks are essentially the most affordable housing in America as a generalization. So that top-down compression pushes the demand way down to mobile home parks, yet there's a limited supply to start off with. So that just cranks up our wait lists, and we have even more demand in the mobile home park space. Mobile home parks also have the lowest loan default percentage of all commercial real estate asset classes. There's a default percentage of a mere 6%. So they're the highest performing loans of all commercial real estate loans is another way to actually say that. Because of this, there's been a lot of awesome lending programs. We leverage Fannie and Freddie financing agency debt on a lot of our properties. We also have a few different types of financing, and I'll talk about that a little bit more in a minute. Manufactured housing as a whole has a 50% lower default rate than multifamily apartments. And I'd like to state that those statistics are coming from what's happening now in the multifamily market, where there's a lot of loans that are in a yucky position because of the flexible rate mortgages that were on the flexible interest rate debt that has been on these multifamily assets. This data is before that. So if we look at what's happening currently, those statistics are going to pair in favor of mobile home parks being a much stronger asset class for the loan performance side of things. Also, if you look at multifamily, there's about a 40% year-on-year turnover. So about every year, if you have 100-unit multifamily apartments, you're going to have about 40 of those units turn over to new tenants. So it's a pretty high volume turnover. The average in the mobile home park space is about 5 to 7% on a nationwide basis. So we have very sticky tenants. Once we bring them in, we have very little turnover. We also get to leverage bonus depreciation in the mobile home park space. We have excellent tax benefits comparative to other real estate asset classes, and arguably mobile home parks are the most appealing when it comes to tax benefits in commercial real estate. So we go out and we do cost segregations for all of our properties to maximize the tax benefits and front load them on year one. And we have a really amazing CPA and tax advisory firm that we work with to maximize that on all of our properties. And then we pass through those tax benefits to our investors. We also, mobile home parks have very low expense ratios. So some of our larger portfolios run at about 25 to 30% on the expense ratio. And maybe some of our smaller portfolios that have really low occupancy, they're running at about 40 to 50%. So really, we can buy a 50% occupied property, be cash flowing straight out of the gate. And then as we increase the occupancy, we obviously exponentially increase the cash flow as well. Also, there's very limited competition in the mobile home park space. As a generalization compared to single family and multifamily, there's not that much competition in the mobile home park space. In addition to that, our specific unique niche of buying 50 to 90% occupied properties, the heavy value add to medium value add stuff, we hardly have any competition in that space. So that dwindles the number who we would even compete against. And then add on top of that, the fact that there's a lot of people that are sitting on the sidelines right now. We actually, this is, Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. Now, I don't believe in greed. I don't believe in fear, but you understand the point that he's making. Basically, he's saying, do the opposite of what other people are doing. Another way that Warren Buffett says that is he says that only dead fish go with the flow. We would like to consider ourselves like a salmon that's actually swimming up the creek and jumping up waterfalls like they do in Alaska. So we've been really conservative and we've been really cautious about the way that we approach our mobile home park investments and our acquisitions since 2015. And all through a market while people have been acting like it's a roaring 20s and people have been buying like crazy in the multifamily and mobile home park space and even self-storage space. And then in about late 2022, early 2023, we started to see people starting to sit on the sidelines and slowing down on their acquisitions because they didn't know how to handle the increasing interest rates and the compressing cap rates. And so we've seen a lot of investors and operators sit on the sides as a generalization since about early 2023. However, since early 2023, while other people are sitting on the sidelines, we already have a strategy in place. We were already ready for interest rates to increase, for cap rates to increase, for construction timelines to take twice as long, and all of the things that were built in our conservative underwriting, which we'll talk more about in a minute. So now it's our time to shine. So we, in this current market, 2023, 2024, we have really strong relationships with brokers. We are one of the most active mobile home park acquirers in the entire industry right now. We have excellent relationships with our brokers and lenders, and we have a lot of opportunities that are coming to us because of this is our time. It's our time to shine, and this is the environment that we thrive in. And should things get even more challenging economically, we're already prepared for that. And we're really excited for those times to provide massive value to investors in the marketplace through that time. So that puts us in a position where we have very limited competition. And it's our belief that if we're taking care of our brokers and our lenders and a lot of people in the industry, while other people can't because they weren't set up correctly, that when properties go on discount, after we have an economic hit and then we start to see things on massive sale, we will be in a prime position, we believe, with strong relationships because we took care of people through the tough times. And so we believe that the brokers and lenders are going to work with us, share a lot of off-market and pocket listings with us in those environments because we're being so loyal to them through the challenging times. And we have very strong recession-resistant qualities in the mobile home park space, which I already mentioned. Cool. So I touched on this earlier. I'll touch on it again. We are heavily vertically integrated. There's two major risks that I like to look at in these mobile home park investments. The first major risk is all of the stuff that happens in the economy and the way that we can't control the economy. So what we can control is our underwriting to combat against all the different metrics in the economy, like increasing interest rates, increasing cap rates, or the potential of increasing timelines for projects, et cetera, which we'll talk more about in a minute. So we've put underwriting metrics in place to combat against those. So we feel like we have a healthy control over a potentially out of control economic environment because we've already put measures in place to allow a lot of flexibility for economic hardship. The other major risk that we see is the execution between going from where our occupancy percentage and the performance is at the closing of our acquisition to us getting to or near 100% occupied and fully maximized. And the most important components of that is speed and also control of the speed and the overall outcome. And so we have our own in-house property management company, in-house asset management company, in-house construction company, and in-house mobile home financing. So number one, we can control that a lot more than if we were going to outsource this and we had to rely on third parties that are less out of our control. Also, we can keep costs and expenses down because we have in-house people instead of paying for additional profits for third-party people. And we also have very well-seasoned people that work on these projects, so they know what our projects are like, and we can rinse and repeat and do the things over and over again instead of training new third-party people that we work with. And we can also control the whole supply chain issues by buying things in bulk and spreading that across our projects and getting bulk discounts and buying materials in advance so that we can go out there and take massive action to complete all of our projects in a really short timeline. The speed of implementation is something that we value really highly here at Cultiv8 Collective. And also the potential for employment risks of there's a lot of contractors out there that have staffing issues, etc. The more that we can control that in-house, we have a lot better control over the overall outcome of the actual performance of the investment. And then we also have our in-house mobile home financing, so we can control the financing portion of that. So we're not subject to third-party financing companies. And we believe that we've pulled together a structure where it really works for the financing and the debt fund, and it works for our investors in the debt fund. It really works to achieve and maintain and sustain affordable housing for our tenants, to make that very attractive and very appealing at the tenant level, and also really jives for the actual mobile home community performance as well. So we believe that it's a win-win-win scenario, bringing in this in-house mobile home financing, and a lot of these things that we've brought to the table, like the in-house construction and the in-house mobile home financing, were components of us problem solving to have a really, really strong competitive edge and solve problems and maintain profitability through recessionary environments. But post-recession, we're going to keep all of these things in place because they just help us perform way better overall. And nobody is going to manage our properties as well as we do. We are super stoked to be doing all of this in-house. So let's talk a little bit about our value add mobile home park strategies. So here's a few things that we do essentially to maximize the net operating income, which is the main driver in the mobile home park place, because it's generally the net operating income that determines the overall value of these properties. And these strategies also help us crank up on cash flow as well. So one of the things we like to do is increase occupancy. So we go in, we buy a community, there'll be vacant homes and vacant lots. We go in there and we remodel these vacant homes at about a cadence of about 7 homes per month per community. And then within about the next 30 days, we'll have those leased up with qualified tenants. And then we also fill lots with new and used homes. So we use a combination of new and used homes to fill those vacant lots and fill them with qualified tenants. We're doing everything humanly possible to get from the current acquisition percentage to 100% occupied in the shortest time frame possible, which cranks up on cash flow, cranks up on net operating income as well. We also convert a lot of our park-owned homes into tenant-owned homes. We do that by leveraging our own in-house mobile home financing. We can also leverage rent credit and rent-to-own programs as well, and just selling homes straight for cash as well, and doing different sales throughout the year. One of the best times to do that is around tax return time, where people have a little bit of tax rebates to work with to put towards home purchases. We also raise rents to market. We buy properties that have been undermanaged and poorly utilized. And so usually they are under market rents. So we can come in there and we can raise them up to rents, increase the quality of the aesthetics of the community, and still be an affordable option in comparative in our market. But there's a lot of value add that we have just from raising rents alone. We get to improve the aesthetics and curb appeal. So in the mobile home park space, we go off a star rating system. 1 star, meaning absolutely terrible mobile home community. You probably wouldn't even want to walk in there. You'd probably feel unsafe. Going to 5-star community, being gated community with security and, swimming pools and clubhouse and etc. All of the bells and whistles. We typically buy in the 2 to 4-star range. And if we bought a community that was a 2.5-star rating, then it usually works out for us to increase that to a maximum of 1.5 stars. So we could go all the way up to about a 4-star rating and it still be profitable for us. And so we are increasing not only the revenue, the occupancy, we're increasing the aesthetics and the star rating of the community from acquisition until we reposition at the sale event. We do that by increasing the landscaping, the roads, signage, putting some gardens in there, tree trimming, general cleanup of the community, also installing utility meters as necessary, running the operations professionally like a smooth oiled machine, and other things of such to increase the actual quality of the community. Some of the other things we do is we improve the decks and the stairs and the skirtings. make sure the yards are cleaner as well. All of these things collectively increase the star rating of a community. We also look to reduce operational costs. So two things, increasing revenue and reducing expenses. And we like to work on those simultaneously. So every month we're looking at how we can optimize and maximize that. One of the other things that we can do to increase the net operating income is bill back utilities. So basically, in mobile home communities, most of our communities are city water, city sewer, and we don't own any other utility systems. In some cases, we might own a septic system or a water well, but that's a pretty rare occasion. And it would be extremely rare if we owned anything else like an electrical system. But in the case of us having city water and city sewer, sometimes there is a master meter where the city connection actually connects to the park. And then we have one meter that reads all the water usage. What we like to do at our communities is we like to then individually meter at each lot so we can bill back the utilities and charge them for the actual usage that they have at each lot. And that ends up being pound for pound, a very profitable venture for us. A real life example of that, I think it cost $75,000 to build back to install water meters that are electrically read and digitally read, and then bill that back to the tenants. And that increased the net operating income to give an additional $500,000 of value to the actual value of the property. So for $75,000, we increased the property's value by $500,000, which was a very awesome return on investment for us. So we like to do that at a lot of our communities as well. And sometimes we can bill back trash. We can also have other bill backs like charge for mowing, where we go in and we mow people's yards for them. And when you look at that at scale, over 100 lots, over 1,000 lots, that can also be very profitable for us as well. So let's take a look at some of the operational improvements we do. So we have our own in-house property management system so we can reduce expenses and optimize systems and increase revenues. We also like to go in there as soon as we take over a community, we improve the outside exterior of all of our park-owned homes. We improve the skirting to make it nice and clean and neat. We make sure that they're well painted and neat exteriors, nice decks and stairs, super clean yards. And then this just automatically increases the aesthetics of the community, and our tenants who own their homes follow suit, clean up their yards, clean up their decks, and we start enforcing that. We set the standard first, and then we start enforcing it so that everybody has nice decks, stairs, skirting, clean outsides of their homes, nicely painted, and everything looks squeaky clean. And we also improve the landscaping and general curb appeal. So we clean up the park. We bring a whole bunch of roll-off dumpsters into our communities to clean out all the vacant homes, all the debris, all of the drainage points and everything. Really clean that up. Do some tree trimming and branch trimming, improved signage at the front of the parks and also internally. And we add some pop factor gardens, and we do road repairs and road resurfacing and patching as needed as well. All of these things increasing the aesthetics of the community. We also like to enforce park rules. So not only do we enforce that people have clean yards, nice decks and stairs and skirting, we also have a strict no pay, no stay policy. So as soon as people pay late, they get their notice. If they don't perform and bring their rent to the table, then we go to court and we evict our tenants. And when we evict our tenants, we actually not only do they have to leave the community, we also take possession of their home. That's the way it works in the mobile home park space. It's very quick to evict tenants. In most communities, it takes about 2 months to go through the eviction process, maybe 3 months. And we collect a security deposit up front, which actually helps cover any delinquency costs so that we break even by the time we're through with our evictions. And we have really awesome systems to make sure that when we move into a community, we clean out all of the bad eggs. We make sure that everybody's paying their rent on time, keeping clean yards, communicating and being nice to their neighbors. and then we have awesome operations thereafter. We also like to implement the build back programs that I actually talked about, where we build back water, sewer, trash, and sometimes additional things like mowing as well. So there's two types of ownerships in the mobile home park space. There's one where the tenant owns their own home, and then there's two where the park owns the home. Now, if the tenant owns the home, they pay lot rent to the community. If it's a park-owned home, the tenant pays lot rent to the community, plus they pay home rent to the community as well. Now, when a tenant owns their home, they're responsible for all of the repairs and maintenance. However, when the park owns the home, the park is responsible for the repairs and maintenance. So what we do is if we buy a property and it has a whole bunch of park-owned homes, we go in there, we remodel the park-owned homes, get them to an excellent standard, and then we do quarterly inspections to make sure that they maintain and stay at an excellent standard. We also have a capital expenditure budget to handle 100% turnover of park-owned homes throughout the hold period, even though there's only a 5 to 7% turnover, annual turnover in the mobile home park space. Plus, we add on some operational expenses. We add about 10 to 15% to our operational expenses for those park-owned homes as well. What we do is we have programs where we actually convert tenants from park-owned homes to tenant-owned homes. And some of the ways we do that is we do that through our mobile home in-house mobile home financing, where instead of the tenant paying us the home rent, they would actually get financing with the mobile home financing in-house, and they'll be paying the home portion to the financing fund and the lot rent portion to the mobile home community. And in that scenario, tenants are responsible for all of repairs and maintenance to their house as well. We also have rent to own and rent credit programs where essentially tenants are working towards home ownership over time. We can also sell these for cash. We sell these homes for cash, and we can do cash discounts anytime throughout the year. We can also do extra sales and offer even bigger discounts come tax time or certain other times throughout the year. And we always aim to keep about 30% or less of our total lots in the portfolio be park-owned homes for our agency qualified properties. So we've got a lot of properties that qualify for agency financing. So those particular communities, we like to keep those at about 30% or less on overall park-owned home to total home ratio. That's something that our Fannie and Freddie financing terms actually like to fit within. But we also really like park-owned homes as well. We're not saying we don't like them. Some operators do, some don't. We love it because we've got our own in-house construction company. We've got our own in-house property management, asset management, maintenance teams. We do remodels on these homes to bring them up to an excellent quality, quarterly inspections. And we also have a nice little piggy bank on the side to be able to handle any turnover. So we actually really like park-owned homes. We find them to be very profitable, and we've found that we're in good markets where tenants really do a good job at taking care of their home. And then we just have a little bit more information on the in-house financing and the different rent and credit programs over there as well. But typically, if we're going to do a rent to own or rent credit program, usually we can exchange home ownership in 3 to 5 years. And yeah, that's our typical setup there. So we basically bring to the table two different acquisition strategies. One is when we are buying a 50% occupied property and we have a refinance. And the other is where we buying 70% plus occupied properties and it's a buy and hold. So we should actually switch over the refi strategy and hold strategy on this slide here, because it's the 50% occupied that has the refi and it's the 70% occupied that has the hold strategy. So what we typically do is we go in, and if we buy a property that's 70% occupied or more, we typically go in, acquisition loan, and then as a generalization, historically, we've set those up to have an 8% preferred return for our investors, and then generally a 70% 30% LP GP split. So 30% of excess cash flow goes to the GP, 70% of excess cash flow goes to investors until the sale event. And typically we have a hold period of about 5 years. Then at the 5-year mark, when we would sell that property, we typically have a 70% of the proceeds of the sale go to LP investors and 30% goes to the general partnership. That's the general typical structure that we've had historically on our buy and holds. We also have increasing tiers for people who write bigger checks. Those tiers were based off people who write a check for about $50,000 minimum. We'll talk about some different tiers that we have where we have higher preferred return and higher split as we have higher check amounts. We'll talk about that in a minute. The other strategy that we leverage is when we go in and buy a 50% occupied property. So usually 50 to 70% occupied. Decent value add in that. Some people would call that heavy value add. And we typically structure those a little differently because we have a refinance in those usually. The way we structure that is typically 8% preferred return, then 100% of excess cash flow going to investors until we get to the refinance, which we usually project to do at about the 3-year mark, although our historicals say that we're doing the refinances around about the 24-month mark. So we're doing it a lot quicker than what we've been stating thus far. Then once we get to the refinance, we typically project to return original capital to investors. So they're out of the investment with a 0 capital balance, but they get to stay in the investment for the rest of the total 5-year cycle. And then after the refinance, the typical structure is 50% of excess cash flow goes to LP investors, 50% goes to the GP, and then the same thing happens at the end of the 5-year sale event. Typically 50% goes to investors and 50% to GP of the net proceeds of the sale. In that scenario, if for any reason investors wouldn't get the 100% of capital back, then let's say they invested $100,000 and we were only able to return $98,000 at the refinance, then that particular investor in this example would be left with a $2,000 capital balance. So post refinance, the preferred return would apply to that $2,000 capital balance. And then the cash flow would be split 50-50 thereafter. And again, that structure, the higher the check, we have a few different tiers in there as well. We'll talk about those where we get an increased preferred return and an increased LP split as the check size increases. The tiers that I spoke about were based off the $50K investment, minimum investment of $50,000. So for our refinance, that's typically 8% pref, with 100% of excess cash flow going to investors until the refinance, where we project to return original capital to investors, leaving investors in the deal with a 0% capital balance, meaning they can go and reinvest that money in another one of our investments or another investment, compound their returns, keep that money flowing, crank up on the overall collective IRR and equity multiple and return on investment, yet still remain in this investment, essentially risk-free because they have their original capital back, and still claim on the post-refi 50% of cash flow and 50% of the net proceeds from the sale. That is the general structure for a $50,000 minimum investment. And the reason that we have these different structures in place is because if we had 10 investors investing $50,000 each, that would make up $500,000. We have to have relationships with 10 people. We get 10 different checks. There are 10 different distribution paths, 10 different K1s, 10 different investor relation communication paths. And that is a lot more work than if we have one investor that brings in a $500K check, that we have one check, one distribution path, one relationship, one communication path. It's a lot easier for us to actually do that. So we reward our investors for writing larger checks because it's a lot easier from an operational perspective for us to do that at scale. The 500K tier, that's actually a 9% pref and a 66.5 split. On the $1 million tier, it's a 9.5% pref with a 70.5 split. So even higher on the preferred return, even higher on the cash flow and equity split there at the $1 million tier. And then our highest tier that we offer is for people who write a $2 million check or above in our refinance structure, where we typically have a 10% pref and a 75-25 LP GP split there as well. So obviously rewarding people for writing larger checks. Then for our buy and hold strategy, we do the same thing, but the splits are a little bit different. So that is where we would go in, get an acquisition loan, hold the property for about 5 to 7 years. Minimum investment of $50,000 typically earns the structure of an 8% pref and a 70-30 split. Then the 500K minimum would typically earn a 9% pref and an 80-20 split. Then the $1 million tier would be a 9.5% pref and an 82.5% split. And then the $2 million tier would be a 10% pref and an 85-15 split. So increasing pref, increasing cash flow and equity split as we receive bigger checks from a singular entity. So we definitely reward our people for writing larger checks and making our life easier on our side of things. The way that we underwrite and project our deals, typically we present investments that come to investors that have at least a 2x equity multiple over a 5-year period. Some of ours have been up near the 3x equity multiple. We'd like to have about a minimum of about 2x equity multiple. And although most of our investments that we've been bringing to the table have about a minimum of a 19% IRR, we typically just wouldn't bring a deal to the table unless it had at least a 15% IRR. But we've seen our IRRs be a lot higher than that for most of our investments so far. And especially when we do our refinances and return that original capital to investors, that really drives up the IRR, sometimes up to the 50 to 60% range, because the return of capital is much quicker. And we also structure our deals so that we feel confident we can actually pay out a preferred return in year one. There's a lot of investors and operators that say, yes, you'll get a preferred return, but they may pay out 0, or they may actually only pay out up to 5% each year. And then they'll tab the rest on the back end. But we've actually got a strong track record of being able to pay our preferred returns. So that's something that we feel really awesome about. One of the things that I'd like to mention is I'm about to talk about our recession-resistant underwriting. This is based off these metrics. So the deals that we bring to the table, we present to investors and say, hey, we're going to have at least a 2x equity multiple. The IRR is over 15%, and it's at least an 8% preferred return and 8% cash flow in year one. That's as a generalization. But the interesting thing behind that is we have these underwriting metrics. So with those projections, we can handle interest rates going up about 2% between now and the 36-month refinance. And a lot of these refinances happen at about the 24-month mark. As a generalization, we usually build in to add about 2% to our current interest rates at the refinance. So we can handle interest rates going up about 2% between now and the 24 to 36-month refinance. We also can do the same thing with our exit caps and our refinance cap rates. We can typically handle about 2% of a cap rate increase between now. We also double our construction costs. We buy bulk materials in advance, and we utilize our in-house construction crew. And we also double our construction timelines. We don't always double our construction costs. We certainly add on at least 20%. But what we've been doing is we've been falling under budget on our capital expenditures in actuality, and we've had money left over once we've got to 100% occupied. So what we're doing with that as a generalization is going out and buying a small mobile home park in a local area adding it to the portfolio, increasing the cash flow, increasing the NOI. Sometimes we can include that additional purchase to the refinance. Sometimes we just hold it, and it adds additional cash flow and NOI, which adds additional equity. So that's a nice way that we like to leverage any additional CapEx that's left over when we come under budget. We also have about a 20% increase on our insurance costs so that we can handle some insurance cost increases. And we also underwrite to have a 10 to 15% expense ratio on our park-owned homes. But in addition to that, we have additional capital expenditures to handle 100% of mobile home, park-owned home turnover. So like I said, each year we have about 5 to 7% turnover in the mobile home park space. So 100% over 5 years means that we could handle 20% a year turnover. So we could handle about 3 to 4 times what the actual turnover is with our capital expenditure budget for our park-owned homes. Plus, we add on an extra 10 to 15% to our expense ratios. So we feel like we've got double padding there for our park-owned homes. We also underwrite with a cadence of bringing in about 20 new homes into the community each year and remodeling about 7 park-owned homes each month across the portfolio. So if we have a 4-park portfolio, we would underwrite to do 7 park-owned home remodels per month in the entire portfolio. Yet in actuality, we're likely going to do 7 per park per month. So we would probably do about 28 remodels in that portfolio per month. So we have about a 2 to 4 times overestimation on the actual speed there. So we end up coming in a lot quicker in actuality on our park-owned home remodels. And we often buy more than 20 homes per year. New homes or used homes to bring into the community, but we underwrite with only 20 homes. So if we bring in 30 homes, then we're going to have an actual much larger cash flow and value of the property for that year in actuality. And we use the least favorable loan term metrics. So if we think that we are going to get a loan at 65 LTV with a 6% interest rate, we underwrite with a 60% LTV and a 6.5% interest rate. Just in case loan terms changed between when we identify the loan until closing. And because of this, we've got a solid track record so far of ending up closing on better loan terms than we actually stated in our original underwriting, which obviously is much more benefit for our investors as well. Some of the other things that we do is that we project to refinance at 36-month mark. So our refinance is usually projected at the end of year 3, although our track record says that that happens at about the 24-month mark. So when that happens in actuality, that increases the IRR and the speed of the money going back to investors and the overall returns as well. And we also build in anything from a 50 to 100% tax increase in year 1 with 5% increase thereafter. Although there has been no property tax increases mentioned, we actually just know that there's been quantitative easing and money printing happening that has to be paid back by the general public in form of taxation. Price inflation is a form of taxation. They could also potentially come for property taxes during our hold period. So we like to build that in front just in case something like that happens throughout the hold period. And we also increase our rents about 10 to 20%. Our rents, about 10 to 20% year on year right now, but we only build in to have a 5% rent increase for most years. Sometimes we'll have a little bit of a bump in year 1 that's above 5%, but from years 2 to 5 and beyond, we typically have a 5% rent increase built into our underwriting. But in actuality, we're raising rents about 10%, maybe a little bit more year on year right now. We also take into consideration underwriting a 5 to 10% expense increase each year, which actually just helps us combat against the actual expenses that are in place. So we find that we typically fall at a lower expense ratio than what we've projected, which then further all in actuality increases the cash flow, returns, and the overall performance of the investment. So a couple of different financing options that we work with. We have attracted a lot of seller financing. We've acquired a lot of mobile home communities with first position and second position seller financing. That's working really, really well for us, especially since 2023. Also, for some of our smaller projects, we work with local banks. And then for some of our larger projects, we work with commercial lenders. We have two specific commercial lenders that we do most of our loans with. They really love working with us. They love the mobile home park space, and we get really good loan terms with those guys. And then our favorite option here, apart from seller financing is our favorite, but our second favorite is agency financing, where we get Fannie and Freddie qualified loans, which typically tend to be the best types of loans in this space, apart from seller financing, where we can basically negotiate whatever terms we want. Our agency financing is really attractive. So a lot of our opportunities, either at the acquisition or at the refi, qualify for agency financing, which also means that the people that buy off us could assume that financing, or they could also qualify for fresh agency financing, which is very, very attractive on exit. And a lot of our portfolios are actually positioned to be able to sell to institutional buyers on exit, which puts us in a really strong position as well. Seller financing happens to be our favorite of all of these loan options because we get to negotiate some really groovy terms. We actually have a deal this year that has seller financing where there's no payment in the first year. Then in the second year, I believe there's a 4% interest rate, and it's interest only. And in the third year, I think it goes up to 4.5%. And then in the fourth and fifth year, it's at 5%. And the whole thing's interest only. And for the first year, there's absolutely no payment. So that's really groovy seller financing. We've negotiated and structured a whole bunch of different seller financing terms for a lot of our acquisitions. Yeah, some of the reasons why you would be interested in joining the Cultiv8 Collective Inner Circle. So our private investment group is called the Cultiv8 Collective Inner Circle. You reach out to our team, scan that QR code, which I'll show you here in a minute, and build a relationship with our team and go through our onboarding process, which is pretty quick and pretty simple, but we make sure that we have relationships with all of our investors. So we want to make sure we get to know you. We want to make sure you guys get to know us very well. And we have opportunities for accredited and sophisticated investors. So we bring 506B investments to the table, where we can have up to 35 non-accredited investors. We also bring 506C investments to the table for accredited investors only, third-party verification required. But we have a combination of both of those investments as well. This is really Cultiv8 Collective Inner Circles for passive investors who are looking to leverage already successful team with a strong track record, so you can invest passively and have us do all of the heavy lifting for you. And also, if you're tired of investing in traditional stock, bonds, and mutual funds, real estate is the flagship, strongest performing asset class time over time if you look at things historically. And also we structure our investments so we believe that they're strong on cash flow and equity. And so there's cash flow and equity splits after the refinance and at the end of the hold period for our investors as well. And the experience that you have working with us at Cultiv8 Collective is that we do monthly distributions. We're actually starting doing this. We used to do quarterly distributions. But not only have we been able to provide our distributions as prescribed or better than prescribed for our operations so far, while a lot of other operations are holding back on distributions, we're additionally moving our quarterly distributions to monthly distributions from 2024 onwards. And then we're going to maintain our quarterly reporting. And we've been told that the reporting we do on a quarterly basis is a lot more in-depth and detailed than other operators. We provide a profit and loss. We also provide a written report of what we achieved over the last 3 months and what we're projecting to achieve over the following 3 months. We have a video from our head of investor relations that actually walks through what we've achieved over the last 3 months and what we're looking to achieve over the next 3 months. We also have a progress video of all of our progress photos of where investor money has been spent and all of the improvements that we've made over the last 3 months as well. Then annually, we provide K1s to our investors so they can claim their bonus depreciation and all of those awesome tax benefits. And like I said, we provide our quarterly reports as well. So I am Bryce Robertson, co-founder and CEO. And here is also my business partner, Nolan Freeman. He is also co-founder and he is Chief Operating Officer. I've been in the mobile home park space since 2015 full time. Nolan came into my world in 2017. We were in a mentor-mentee relationship for about 3 years until we finally partnered and brought him in-house. And we've been really expanding our portfolio and exponentially growing since 2021. And he's an amazing partner. When you look at personality profiles, my personality is the complete opposite of his personality. So when you match us both together, we are the perfect business partners because we complement each other's strengths and weaknesses and put us together. And we're kind of like a superhuman business being. And that's us. Then we also have a really, really amazing team, which we didn't mention in these slides. We have awesome investor relations team, an acquisitions team. We've got amazing operations teams with director of development and regional managers and construction team and construction managers and on-site managers and et cetera, et cetera. And we've got a really decent sized support team as well that we're always growing and expanding. And we like to grow our team in anticipation of growth. So we like to bring on our team members about 6 months before they actually need to be with us so that we can stay ahead of the growth curve as well. Little mention on some of our support team here. This is certainly not all of our support team, but Innovate Collective is our property management company, our in-house property management company. Cultiv8 Collective, our in-house asset management company. We also have our construction company and our in-house mobile home financing as well, which is not mentioned on these slides. We also work with Provision, who are our tax advisors and accounting firm. They literally work with some of the top operators in the US. And some very high net worth individuals. They're really good at advising on sale events and also tax and accounting. We also leverage the MHP lawyer who specialize in mobile home park legal aspects, and Feed Nerman, the principal over at Ferd Neiman over at MHP Lawyer. He's actually a mobile home park owner himself. And so he helps us with our legal side of things from the transactional and real estate side of things. And it's really good to have somebody who is in the trenches, owns mobile home parks and really, really gets it. So we love working with those guys, and they kind of work in conjunction for us with Premier Law Group, who help us with our syndications and the SEC side of things. And Mauricio Raoul is definitely one of the best in the business. We absolutely love working him. And so we actually work with both of those guys, and they complement each other very well for our particular structure. Also got some mention of some other partners that we work with here as well. And again, this certainly isn't mentioning everybody that we work with. This is just mentioning some of the high level people that we work with here. So we are Cultiv8 Collective, and we are, as of now, this presentation was put together right at the end of 2023. We have about 50 million of acquisitions that we're working on right now. We are looking to take on about 150 million in acquisitions in 2024. We are super excited to open this up for you to join our inner circle so that you can access our off-market mobile home park investments and work with us and collaborate together. So we're super excited to have you join us and come into our world. So do yourself a favor, make sure to scan that QR code and then you will end up teaming up with Jordan Stenholm, our awesome head of investor relations. She will jump on a call with you and help you with the onboarding process, answer any of your questions. And I really, really look forward to having you come into our world, and so that we can make your life better and we can help improve your financial freedom and your time freedom and your ability to contribute to the planet in the way that you truly want to and deserve to. I hope this has been a very valuable presentation for you. I'm looking forward to spending a lot more time together. Thank you very much.